guys, it's Doc's Market Minute for Tuesday, December 29th. Around this time of year, I like to do the top lessons for that year. So sometimes these are the same from year to year to year, and it makes sense to kind of go back and revisit them and sort of amplify the lessons that the market is always trying to teach us. And so some of these are the same, some of these are going to be slightly new from 2014. So today I'll do part one, and then tomorrow I'll finish it up for the year with part two of these lessons. So number one is expansion leads to contraction. Expansion leads to contraction. And I think we can see this everywhere we look at the market. When we see an expansion move, right, that comes from a contraction move. So expansion leads to contraction. So expansion like this, when we expand the range, leads to contraction. Look how this has just been one big, huge consolidation zone, essentially since the latter part of 2014. So about a whole year's worth of just going nowhere at all. In fact, right now 2015 is just marginally positive on the S&P and is getting that way on the Dow. So it's just inching towards a positive close for 2015 right now. Expansion leads to contraction. Now that leads me to my number two lesson for 2015 is that contraction leads to expansion. Contraction leads to expansion. So you can see this on the weekly chart here where we had all this contraction, all this range bound price action that made people just go absolutely crazy from the spring all the way through the late summer of 2015. All of this is just range contraction, and that leads to range expansion. It's like a big spring winding up, getting tighter and tighter, and then it just can't stand it anymore. It either is going to break or spring out of your hands. This is exactly what happens. Now, this is where we have to be very sensitive to price action because this movement can go either way. So we have to watch very carefully and kind of box in the price action to understand when it finally does leave that pattern, which way it is moving. And it was very obvious that after a day or two, it was moving to the downside. So that's our number two lesson for 2015, and it's a fairly timeless one. We could do this just about every year. Contraction of the price leads to expansion of the price. Now the number three lesson for 2015, again, I'm going to pull out the monthly chart here because I think this is going to give us the best view of this. Now, there's a lot of folks that are out there that are going around saying the market is a random walk down Wall Street. It's completely random. Any particular day's price action is random in the context of any other price action of any other day, and nobody can figure out where the market's going. Well, that's great, but I don't think those people spend much time studying the market, and we do. So what we find is that we have the same kind of patterns running again and again because, of course, the market is based on investor psychology and herd behavior of the crowd. And so what happens is we get the same patterns again and again. And so the one that I want to highlight here is that quiet and trending price behavior. And this is something that we had for a long time through the early, 2000s, okay, up until maybe 2007 or so. Quiet and trending migrates to volatile and sideways price behavior. It always happens this way. Quiet and trending, this is a quiet and trending market. Remember, I used to refer to this as Groundhog Day. It's seemingly every day the price would sort of inch higher. We get a little bit of a gap down and then it would close that gap and then go higher for the day. We saw this for literally years at a time. So what happens from here is this quiet and trending price behavior all of a sudden becomes unstable. And we can see other examples of this. Quiet and trending price behavior all of a sudden becomes unstable and it turns into what's called volatile and sideways price behavior. Now, sometimes it resolves to the upside, sometimes it resolves to the downside. So that's a whole other issue that we have to determine is when the price does turn into this volatile and sideways, which way is it breaking from there? And guess what's happening right now? We had quiet and trending price action all the way into pretty much the latter part of 2014. has turned into volatile and sideways, especially since this August. So which way is it going to break from here? Well, that's obviously something that's going to be very important because we're recognizing this signature, quiet and trending, breaking into volatile and sideways. So that's our number 3 lesson. And I'll finish up the last lesson for part 1 today, is that extremes usually lead to reversals. Extremes usually lead to reversals. Now, when I say extremes, I'm talking about extremes in sentiment, and where we typically find the extremes in sentiment is usually to the downside. And this is where we have people that are just, these are where we get into the situations where people are just screaming bloody murder. We had one of these situations on this day in August of this year where we woke up in the morning and the futures were already down as much as it started out modestly down at 30, 40 points. But as we got closer and closer to the cash market open, we eventually did a limit down at minus 100 points. So the S&P lock limited and stopped trading on the futures, the Globex futures, before the cash market opened at 9:30 Eastern at 100 down. And that to me was a good example of where we get into these completely out of control sentiment values, and that marked an extreme for me. So on this morning, and it was actually kind of difficult because when we get into these really, really nasty days, sometimes your broker interface will slow down because of all the activity, especially the web-based interfaces can't paint screens fast enough. The heavy client type interfaces, the data feed slows down. It can be very difficult, and the spreads are as wide as a truck. So understanding exactly what you're selling and what you're buying can be a little bit of a challenge. So we don't see these types of days that often, but when they do show up, the herd, of course, is completely bummed out by this. And when I see something like this is when I get very, very aggressive and will take the other side of the trade. And you can take the other side of the trade in many, many different fashions. Usually we have a huge spike in applied volatility, so buying things like call options are probably not a good idea. This is where I'm typically selling something either right at the money for maximum credit or a mile out of the money for maximum distance, depending on what it is that I'm trying to do. But we can see these types of situations occur from time to time. They are a very, very high probability event because, again, you're taking the opposite side of the extreme sentiment. And usually what happens is a relief rally shows up in the next day or two and creates instant profits for you. Now, just from an objective perspective, sometimes that you'll see these measured by tick values that are typically starting off the day, or during the waterfall decline, they can be as much as minus 1,600 or so. Usually the biggest spike to the downside that we'll typically see is maybe 1,000 to 1,200 or so. And so it's very, very rare when we see sustained selling that gets below there. So when we get down to like 1,600, 1,500 or so, that's usually one objective sign that we've reached a selling climax. And the other one that I'll use is just the daily advancers on the S&P. So you can see this. Out of 500 stocks on the S&P 500, this is the number that are advancing on the day. And you can see this horizontal line that I have down here marked with 10. If we close below 10, which we did a couple of days here, so not only in late August, but also early September, one of the early September days, we actually closed below the 10 value. That represents an extreme sentiment value to me. So think about that. Out of 500 stocks in the S&P 500, only 10 of them or fewer are advancing on the day, and that's an extreme sentiment value. Usually we see a very quick reversal right after that point. Okay, so that was our final lesson for today from the market. The market is always trying to teach us lessons, and that was the final one for today of part 1, which is extremes in sentiment lead to very, very rapid reversals. Usually we see these rapid reversals more likely on the downside than the upside. Usually markets can go higher for much further than we expect. So even though we think it's a sentiment extreme to the upside, it's usually not. It's usually when everybody gives up and finally turns into a bull and we run out of sellers that we get that reversal on the upside. So it's easier to quantify and measure these to the downside. Okay, that is today's list. I'll be back tomorrow with another set of lessons from 2015. Take care, folks.